Hello learners, welcome to our session today. I am your instructor, CPA ARINGO FREDRICK. In our class today, my good students, we are going to look at a very important concept, not only in our syllabus or not only in this course, but in our finance career. This concept is very and most commonly applicable when it comes to finance. And the concept that we want to study today is a concept known as what? The time value of money. TVM. TVM is a concept that I want us to understand today. We are going to dig deep into time value of money so that we should be able to understand the whole concept of time value of money. So anytime you're talking about time value, I know probably it will not be the first time that you're hearing this term. Maybe you've heard it somewhere. So what is the whole concept behind it? You'll find that at this point, maybe look at it in a very practical perspective. You'll find that at times, or many a times, I'll prefer to receive a certain amount today rather than me receiving that amount, say, tomorrow. It's better you give me that cash today rather than giving me that cash tomorrow. There's a very important concept that should stick at the back of our mind. Why should I prefer to receive that cash today and not tomorrow? Because there's that concept of time value of money. Probably tomorrow, this money could have reduced its value. So it's better I receive that cash today. And that's how we are talking about the time value of money. So the whole concept behind time value of money, you'll find that it normally tends to outline the fact that the value of money does not remain constant, but rather it changes from time to time. So at this point, you'll find that that's why we are saying that tomorrow probably the value of this money could have reduced. So we are saying that it does not remain constant, but it normally changes from time to time. The concept of time value of money emphasizes the fact that an amount of money received today is better than if it is being received in future. So you'll find that the future value is not equal to the present value. That is what you are looking at. The future value is not equal to the present value. So I better receive this cash today rather than tomorrow. So maybe for those who are putting notes, you can note this briefly and say that the concept of time value of money emphasizes the fact that an amount of money received in the future is not as valuable. We are saying, for those who are putting it down, we are saying the concept of time value of money emphasizes the fact that an amount of money received in future is not as valuable as the same amount of money receivable today. It's not as valuable as the same amount of money receivable today. Meaning that the future value is not equal to the present, is not equal to the present value. So my good student, those are some of the key concepts that you must understand anytime you're talking about the time value of money. That's the whole concept, that the present value of money is kind of so much higher than the future value. And we could be having reasons probably why the future value is very uncertain. Probably you can be asked, why should we receive that cash today rather than tomorrow? This is simply because, my good student, will find that future is associated with a lot of uncertainties. The future is associated with a lot of uncertainties. And as such, these uncertainties might tend to affect the value of this money, whereby we'll be looking at it in this case, factors that might tend to affect the future value of money. We'll be talking about the rate of inflation, for example. Rate of inflation. This is a point whereby we are looking at an increase in prices of goods and services within an economy. And as such, you'll find that that might tend to reduce the value of our money. So number one, we are talking about inflation. Number two, we'll be talking about interest rates. This one is also a factor that might affect the value of money, And of course, talk about risk premiums. And so many other factors that will affect our value of money in future. And that's why you normally tend to say that anytime we were to talk about the time value of money, the key concept that should always click at the back of our mind is that I am looking at that value of money today compared to if we'll have received the same amount tomorrow. Now, other important concept that we should also be able to understand at this point, my good student, is what if we were asked, now, what is the importance of the time value of money? Because that is also a very key concept that you must always tend to ask ourselves. Importance of time value of money. So that should take us to the importance of time value of money. I want us to look at importance of time value of money. Importance of time value of money. If we are asked on the importance of time value of money, what will click at the back of our mind? By now, because we have the concept right, I know we can now kind of give the importance. What's the importance of us receiving, or rather of us understanding this concept clearly? So you'll find that the main importance of the concept of time value of money, it will help an investor to arrive at the comparable value of different amount arising at different points of time into equivalent values of a particular point of time. That is either present or future. So we are saying that the main importance of time value of money is going to assist me as an investor in making the decision of should I invest today or should I invest tomorrow? As simple as that. Whereby, how? That is another question. It's going to assist us to compare the return if I invest today and the return if I wait and invest tomorrow. So you'll find that at this time is going to kind of give us or assist us to make such decisions, whereby at this point you'll find that the time value of money, we normally tend to look at it into two areas, and in this case we normally tend to say that this concept is going to be broken down into two. The concept of time value of money is going to be broken down into two areas. So the concept we're saying is going to be broken down into two areas, going to be broken down into two. And at this point, we'll be looking at it in terms of the present value and the future value. So we are saying that this concept, we are going to break this concept into two. That is the present value and the future value. And the future value, we are going to break this concept into two. That is the present value and the future value. Now, at this point, probably a person will ask, Mwalimu, when you are talking of present value ideally, what do you mean? And when you are talking about the future value again, what do you mean? So these are the concepts that I wish them to stick at the back of our mind. Let us start by understanding the present value. Because at this point, you're just saying present value, future values. I want us to understand the concept of present value. When you're talking about present value, what should click at the back of our mind? Anytime you're talking about present value, my good students, what should we understand? So, anytime that we'll be looking at a present value, you'll find this determines what cash flow to be received in the future, worth in today's dollars or in today's value. I repeat that again. We are saying that anytime you're talking about present value, This determines what cash flows. It determines what cash flow. It determines what cash flows. It determines what cash flows to be received in the future. To be received. To be received in the future. 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 To be received in the future is worth in today's value. Maybe you use reserve currency, dollars, right? So we are looking at it in that case, whereby anytime you're talking about present value, you're saying that we are looking at a concept that this concept determines what cash flow to be received in the future is worth in today's value. Is worth in today's value. So that assuming that I was to receive this cash in future, how much is it worth today? How much is it worth today? How much is it worth today? That is the aspect to do with the present value. And the other case will be, what about future value? For future value, my good students, for future value, we are looking at future value determines the cash flow. This one determines the cash flows, determines the cash flows received today, or rather what a cash flow received today determines what a cash flow received today determines what a cash flow received today, what a cash flow received today is worth in the future, is worth in the future, is worth in the future, is worth in the future. So that's a concept that I want us to always have at the back of our mind anytime we are looking at the present or the aspect to do the time value of money. We've said that this concept is going to be broken down into two, whereby you'll be talking of the present value and the future value. So anytime you're talking about the present value you're looking at, it determines what cash flow to be received in future is worth in today's value. Whereas the future value, we are looking at it in a form whereby it determines what a cash flow received today is worth in the future. You can clearly see that we do have the difference between this concept, the aspect of the present value and the aspect of the future value, And what we should always have in mind again, and what should always stick at the back of our mind, that both present value and future value, both of these, both present value and future value, both present value and future value, they normally take into account the compounding interest. They normally take into account the concept known as compounding interest, or the aspect of capital gains. So we are looking at it as the aspect both of the present value and future value. They are going to take into account what is known as what? The compounding interest. What is known as the compounding interest. So this is one key element, my good students, that you must always tend to understand and have at the back of our mind. But again, we should never confuse the concept of time value of money and the preference of money. So this case, or these concepts, ideally, we are looking at it into two different perspectives. Because at times, again, you can be asked to define what time preference of money is. These are two different terms. The time value of money and time preference of money. Get the difference between the two. We are talking about, at this point, we talk about the time value of money, right? What if, on the other case, we were asked to mention or to give the difference or to define what time preference of money is, because they are two different. Time preference of money. Time preference of money. We can be told this to differentiate maybe between time value of money and time preference of money. And that's why if you check in your papers, this is financial management section 3. If you can check in your paper, financial management section 3, a question was tested in November 2018, question number 1B. Question number 1B. Question number 1B, Roman number 3. Look at that question. November 2018, question number 1B, Roman 3. We were told to distinguish between time value of money and time preference of money. Ideally, they are two different definitions. So to this point, my good students, today we've analyzed the concept of time value of money. I want you to meet me in the next session whereby we are also going to analyze the concept to do with time preference of money. And it is on the same section that you're going to look at the concept to do with compounding and discounting techniques. Thank you so much, and let us meet in the next session. Thank you.